Welcome back, Alpha Hunters. Okay, we got a new order today. It's called the calendar order. And I will go through some of the basics and give you my thoughts on the order. And then we will switch over to the broker and look at a risk profile chart of just how it works. Okay, and where you can expect profits and losses. So as we continue our journey to fill out this option strategy template, we have the single order, we have the vertical order, and now we have the calendar order. And I bet many of you thought that this order was actually going to be called the horizontal order, but it's not. I kind of tricked you. Not really tricked you. It's just called the calendar order. And I'll explain that a little bit more as we switch over to the broker, and I'll show you why the vertical is called the vertical and the calendar is called the calendar. Okay? But the basic principles of how you want to set up the call calendar is you want to sell this near-term call, right? You want to sell this near-term call, and then you want some time in between, and then you want to buy a farther out call, okay? So that's what you're looking to do here. You can do the same thing with puts, but typically in most practical applications, you'll be doing this with the call side, but you could definitely find some stocks to do this on the put side, but you'll do the same thing. You'll sell a put on the near term, you'll have some time in between, and then you'll buy a put in the long term. Now that we have the top three rows taken care of and filled in, let's fill in these second and third columns here, okay? So we got the expiration date and we got the strike, okay? So for the single order, okay, really, come on, doesn't need anything self-explanatory. It's just a single order, so it doesn't really need any explaining there, okay? But the vertical and calendar. So what you notice is the vertical expiration is the same, but the strike is different. Okay, so you're going to do a different strike here. For the calendar, the expiration is different, but the strike is the same. So this is where the order here for the time, this is not waiting a week before you enter your buy order for your option. Okay, this is selling a call and buying a call in the same order, at the same time, the same execution, but the time difference here is just the expiration date. Okay. So you're selling a 2-week out call, but you're buying a 6-month out call, right? That is kind of how you're wanting to set up this trade to enter this trade, okay? So now that we have this strategy template, we will see this kind of going forward. So any strategies and all strategies that you see going forward, they are just going to be made up of really these three lines, okay? So don't overcomplicate things. You find something you like, stick to it. So let's break down these calendar orders, right? So a call calendar, what we are looking to do is sell a call with multiple expiration dates in between, and then buy a call on the longer term, right? So that is what we're looking to do. And this is going to be really good for stocks that are just trending in the upward direction, kind of going sideways, that kind of thing. We are not looking for bearish moves at all. We don't want bearish moves. Now for cash flow, we are going to have a credit in when we're selling a call. We're going to have a debit out, so we'll pay cash out when we buy a call. Now the longer term call that we're buying will cost more, so it will be a net debit trade. The reason why I broke this apart is something I will explain later. So losses, we do not want the stock to have a dramatic move. So we are looking for something that is predictable, maybe even range bound, but it has very predictable moves. It's very steady in its trend and that kind of thing. So the break even, it's going to depend a little bit, but we will look more at this when we get to the risk profiles on the broker. Now what we're looking for on the profit side is just stocks that are in a predictable bullish trend. You know, we're not looking for dramatic moves, right? That's going to be the bad side here. And all we're looking to do is have the sold call, the near-term call, just decrease in value. Okay? So on the put side, it's very similar. Okay? We're going to sell a put near-term with multiple expiration dates in between, and then we'll buy a put on the long term. We're looking for a stock that is on the decline or kind of going sideways. We're going to take a credit in on the near-term put that we sold, and we will have a debit and cash going out on the long-term put. But again, to set up the trade, it will be a net debit. Now for the loss side, we're not looking for dramatic moves in the stock. We're just kind of looking for a very consistent trend. Okay, break even is going to depend again, and then stocks that are a predictable bearish trend, we're just looking for the sold put to decrease in value. Okay, so that's how we're going to profit from a put calendar. So some of my thoughts on this calendar order is it's a little bit more complex to set up because you're having to deal with two different expiration dates, but it's still a pretty easy strategy, and it's actually a great strategy. Generate that cash flow. That's what we're looking for. We're just looking at that cash flow, and how we're going to generate that cash flow is by using Theta to our advantage. Okay, by selling that near-term option, it will have more Theta decay than the longer-term option that we bought. So real quick, an example. So let's say we have a near-term option that's expiring about 3 weeks out. Okay, and we'll say the strike is at 150, and we also have a long-term option that's expiring 6 months out, and the strike of that one is at 150. Okay, so obviously the near term, we want to sell that position. So we'll have a -1 here, indicating that we sold that position. And for the long term, we bought that. So we have a +1 there. So we bought that, we own that, and we sold the near term. So let's say the Theta for that near term option has a -17. And the long term option, we'll say, has a -0.2. So every day, we are expecting roughly the day change to increase our position for the near term by $17 for the near term option, and the long term position to decrease by $2. So the net change of our position will be an increase of $15. That's what we are looking to capture, is that $15 every day, until our near-term option expires, and then we can close out the whole trade if we need to, or we can sell another near-term option. That is the basic principle of what we are trying to do with this strategy. So if you like these examples, give this video a like, and let me know in the comment section if you need better clarification. So again, it is going to be great in a steady trend. And dramatic moves, they're going to be bad. This is not a strategy that we want to use if we are looking for dramatic moves or we're wanting dramatic moves to happen. Selling near-term options are good for cash flow. And that just kind of goes with any option strategy. Selling near-term options is going to be really good for cash flow. Another thing that you can do with the strategy, I just mentioned it just in that example, but you can rinse and repeat the sold position. Or if the stock makes a little bit of more of a move than what you thought, you can roll the option out if need be. So give me a quick second. Let me switch over to the broker. Okay, here we are back in the broker. So real quick, let me tell you why the vertical is called the vertical and the calendar is called the calendar. Okay, before we get into analyzing the calendar and the risk profile. So as you look here at this option chain, right, we're just looking at the Jan 3, 2022 option chain. And you notice the option chain is in a vertical. So we're not looking at different expiration dates. We're just looking at strike prices for this expiration, and it's laid out in a vertical orientation. Now, when you look at the calendar, and the reason why it's called a calendar is sometimes, I get that on the screen they're vertical. They're in a vertical orientation, but some brokers have them in a horizontal orientation. Just because they're in a vertical orientation here doesn't mean that they're also vertical. No, it doesn't mean that. You're going against different expirations, and some brokers have them oriented different. Okay, so what we're going to look at now is the call calendar. Okay, so we're going to look at selling a near-term option, and then we are going to buy a longer-term option. So let's go ahead and sell this 455 strike for January 3rd. Okay, so I'm going to say, so what we can do is actually come in here and we can buy a calendar, and it will set it up just as we need to. We're going to sell the short-term one, and then we're going to buy this longer-term one, right? So that's what we're looking to do. And you see over here it says calendar on the left side of the trade. But this is where, if you do this kind of setup, it always, in thinkorswim at least, it always defaults it to the next expiration. So we don't want to do that. We would want to go out to Jan, we'll look at Jan 30. We'll go about 6 months out. So the one we're looking to sell is about 2 weeks out, and then the one we're looking to buy is about 6 months out. Okay? And the cool thing, so if you wanted to set up a trade like this is kind of how you would do it. But just make sure you get the right expiration dates. That is crucial to this strategy. Okay? But I'm going to set it up a little different. What I'm going to do is I'm going to set it up each individually. That way I can toggle it in the broker. Okay? So, yeah. Okay, so one quick thing before we continue to look at it and to analyze. So let's say we are going to sell, obviously, this 455, this one that we have highlighted. We'll sell this for roughly $6. And that's $6 per share. So that would be $600. So we'll sell that for roughly $600. And then we'll buy this 455 out 6 months. And we'll buy that for roughly $26.50. Okay? So we're looking for this to decrease in value by $26 a day. So we'll be able to make $26 a day on the near term with Theta. And then we'll only lose $7 a day on the longer term one from Theta. Okay? So we'll be making roughly $20 a day from Theta decay. As long as the stock doesn't move that much, that's about how much we'll be making. Okay? So when we get to the future, now if you want to sell and close out of your position in this longer term position in the future, like let's say your 2 weeks go by, a short term option that you sold, let's say it expires worthless, and you'd rather just get out of the trade and close your long term option, you can definitely do that. And if you want to know about roughly how much that value of the option is going to be, well, just go to a we're expecting this trade to be about 2 weeks. So go to about a 2 week less option, a 2 week less expiration option, right? So we're looking to buy this longer term June 30. So go to 2 weeks less of that, and it'll be the June 17. And then go find that strike and then see how much it's trading for. And that difference is what you'd be able to roughly close out for. So right now it's trading for about $25.50, right? So that's about how much we would be able to get out for. So it'd be about $2,500, but we're going to be getting in for about $2,600. Okay, so that's how you can kind of plan that. So we're going to take about $1,000 hit there, not $1,000, I'm sorry, $100 hit there, but we're looking to make about $600 selling the near-term option. Okay, so we'll lose about $100 on the long-term option, but we're gonna look to make $600 on the near-term option. Okay, from Theta Decay. So that is kind of how you can plan around this strategy. And I would not do the strategy on options that are just really not that liquid, as some of the bid-ask spreads can really kind of eat into your near-term option Theta Decay, okay? Especially on the long-term options. Long-term options, the bid-ask gets a little wide. So let's look at the analyze, okay? So this is how a basic call calendar will look in the setup, right? So we're going to look to sell. I'm going to refresh these prices real quick. So we're going to look to sell this short-term option here for roughly $640, okay? Roughly $640, and then we're going to look to buy that longer-term option for about $2,700. So it does potentially cost a little bit to kind of get into the trade. So this might not be for a lot of beginners. Just kind of depends on where your account portfolio is. And you can definitely go shorter than 6 months. Like if you can't afford 2,600, but maybe you can afford something maybe in the March. Oh, that was March 23. Sorry. We want March 22. There we go. Okay, so maybe you can afford something like in the $1,900 area. Sorry for that little mistake, but just that's where you need to know what you're doing. And one reason why I do want to show this while I do this live is to kind of see like how things can get messed up if you don't set things up correctly. So you definitely want to be aware of what you're doing, okay? And if the price doesn't change, or if the price doesn't look right to what you're expecting on the setup, definitely reanalyze like all the options and make sure all the settings are correct, okay? You don't want to get into something that you didn't intend to. But this will allow you, if you need to go with a shorter time frame for like the longer term option to maybe get into one, you can definitely do that. So this is how you want to set this up, okay? You got, looking to collect 600, you're going to pay about 2,600 or so. And how this looks is just kind of like an A. Now, previously I have mentioned that the blue, this light blue line, the teal line, now that is your expiration, right? But which expiration is that calculating off of? That's kind of why this expiration line is curved. It is not straight, right? Previously, and in most strategies, that it will be straight. The only time you will see curved line on your expiration is when you have a calendar position open. Is when you have two different expirations or multiple expirations in the analysis. So that is the only time you will see this kind of curvature on your expiration line. Okay. Now the purple line, that is what we are looking for the value of the options to be as they move across the date, or whatever date that line is representing. So right now it's representing December 20th. And if it went to whatever price level, the prices are down below, that's the value that it would be corresponding on the left side. Okay. So as we roll this forward in time, so I'm going to roll this forward in time until we get to the call that we sold, right? So we sold the January 3rd call. So I'm going to roll this date and forward in time, and you just kind of see what the purple line does, right? It's increasing, it's increasing, it's continuing to increase, and that is what we are looking to capture with this strategy. Is just the daily incremental increase in value from theta decay, okay? Until you get all of that reward, right? And we're looking to capture about $450 or so. So that's about what we are looking to capture. And that makes perfect sense because between what we're going to make here on the sold option to what we're going to lose on the long-term option, that was roughly what we're looking to gain. It's about $600 or so. Okay. So that is how you set this up. That is how you can expect the trade to work out. And obviously, as you look at the risk profile, it doesn't matter really along what time frame you're looking at. It is not good for our position if the stock has wild swings up to the upsides or downside. Okay, that is not what we are looking for in this strategy. We are looking for just a consistent, just steady, easy-going stock in the upward trend or downward trend. If we were to switch this over to puts, if you want to know what this will look like if we switch this over to puts, it'll look the exact same, right? So this is how puts would look. Let me even change the strikes. I'll change this around just a little bit to different strikes. Let's say 447 and 447. Refresh the prices. Yep. Okay. Refresh the prices. There we go. So it looks dang near identical, right? It's a little identical, almost identical, different profit loss areas, but you don't want dramatic swings. Okay. Now, what happens to these trades when you get past your expiration? So let's say you get to your expiration, right? And we'll say that put the near term put or the near term option, we'll say just expires worthless. And then what winds up happening is then you have this long-term position on this put. All right, so then it switched to this risk profile of just long a put. Okay, so that is where the position will change, and you will just then be long the put if you do not re-up or resell another short-term position or that kind of thing, or just close it out. You could close it out, but just understand however you want to continue on with the trade, close it out or re-up another one. Either way, how you want to do it is completely fine. Alrighty, take care, Alpha Hunters.